Welcome back to the Deep Dive. We are tearing through the latest earnings calls. And today we're focused squarely on Xcel Energy's Q3 2025 results.
Yeah.
Now, utility calls, they usually focus on stability, maybe some maintenance chatter.
Pretty standard stuff, usually.
But this quarter, wow, Xcel's management had, well, one overwhelming message.
Mm-hmm.
They are building the regulated grid platform needed for this emerging AI data center boom.
That's exactly it.
Yeah.
That's the core thesis. And frankly, it's why the market reacted the way it did, positively. This wasn't, your typical discussion about seasonal electricity usage or storm cost.
Right.
The conversation, it just decisively shifted. It was all about unveiling this monumental multi-year infrastructure vision. Management really successfully, I think, recast the company story from like a standard regulated utility to a regulated platform builder serving this huge secular demand, electrification, AI, compute power, the whole package.
Okay, let's get into the hard numbers first, because, at first glance, the earnings side looked a bit like a train wreck.
It did, yeah. If you just looked at the headline figures, definitely. Xcel reported raw GAAP earnings per share of $0.88.
And the consensus was $1.30. That's a big miss.
A significant miss, yeah. But that discrepancy, it points directly to one thing, the Marshall wildfire settlement.
Okay, so tell us about that delta. What happened there?
So Xcel took this non-recurring charge, about $290 million. That translated to roughly $1.30 per share.
Okay.
And since that was a known, one-time settlement event, analysts just stripped it out. So if you look at the ongoing, or the non-GAAP, the EPS Xcel delivered $1.24 per share.
Which was only slightly off the $1.31 consensus.
Exactly, just a slight miss. So the market pretty quickly recognized that the earnings shortfall itself was, well, transient noise. It wasn't the real story.
And the momentum clearly was on the revenue side then.
Definitely.
Xcel delivered a decisive beat there, brought in $3.92 billion against a $3.89 billion consensus.
Right, and that's a strong 7.4% increase year over year. Solid growth.
Yeah.
So that revenue beat, it signals underlying demand strength. And when you pair that with the clear explanation of the Marshall fire charge,
it makes sense why the stock moved up.
Precisely. Investors saw the operational strength in the revenue, and they focused their attention squarely on the long-term strategic plan, which, as you said, is where the real story is.
Right, that long-term plan. That's why we're doing this deep dive, really. Management didn't just tweak their capital budget. They introduced a, staggering new $60 billion 5-year infrastructure investment forecast.
Staggering is the word. $60 billion.
How does a utility even handle that scale of capital stack? Without massive dilution or huge regulatory pushback.
Well, the sheer scale is unprecedented for Xcel, no doubt. But it's not just arbitrary spending, right? This CapEx, it's designed specifically to accelerate their engine of profitability, which is the rate base.
Okay.
Management explicitly stated this investment level is expected to deliver an aggressive, get this, 11% rate base compound annual growth rate, CAGR, through 2030.
Wait, hang on. An 11% rate-based CAGR, that sounds, incredible. But for our listener who might be focusing more on the revenue numbers, can you quickly explain what the rate base is and why its growth is just so crucial for a regulated utility like Xcel?
Absolutely, good point. So the rate base, it's basically the total value of their assets. Think power plants, wires, transformers, all that stuff. It's the value on which a regulated utility is allowed by state regulators to earn a guaranteed rate of return.
Got it. The pool of assets they earn profit on.
Exactly. So growing that number, that rate base, by 11% annually, that's the fundamental engine driving their entire financial growth story. That 11% is the number that dictates their future EPS potential, really.
Okay, so if the rate base is the engine, what are they actually building with the $60 billion to keep that engine running so fast?
Right. What's the money for? They're building a resilient, high-capacity grid designed for the future. So the plan includes 7.5 gigawatts of zero-carbon renewable generation. That's to meet policy goals and, customer demand.
Okay, renewables. Makes sense.
But crucially, they're also adding significant firming capacity. So 3.0 gigawatts of natural gas-fired generation and 1.9 gigawatts of storage. Battery storage, presumably.
Yeah.
And they really emphasize that those gas and storage parts are, non-negotiable for system reliability, especially as the grid gets more renewables, which are intermittent.
Right. You need something dispatchable when the sun isn't shining or the wind isn't blowing.
Precisely.
And linking all that new capacity, the renewables, the gas, the storage, linking it all to the customers requires major heavy lifting on the physical infrastructure side, the wire.
Oh, absolutely.
It does.
They plan to install 1,500 miles of new high-voltage transmission.
1,500 miles.
Yeah. I mean, think about that for a second. That's like laying a new high-speed power line from, say, Denver all the way past the border into Canada.
Wow.
It's a huge logistical challenge, not just a financial one.
Yeah, I bet.
And importantly, they also dedicated $5 billion of that CapEx specifically to wildfire mitigation and hardening the distribution and transmission systems.
Which seems like a very necessary investment, given their recent history and, well, the climate realities.
Absolutely necessary. A key part of gaining regulatory and public support, too, I'd imagine.
Okay, let's connect this massive plan directly to management's financial guidance then. They reaffirmed their 2025 ongoing EPS guidance at $3.75 to $3.85.
We did, which signals confidence, right?
Mm.
Despite those near-term cost pressures we saw in Q3, the full-year outlook seems secure in their view. But more importantly, I think, for the long-term valuation.
Oh.
They initiated their 2026 EPS guidance.
Okay, what's that looking like?
They set it at $4.04 to $4.16, which, if you look at the midpoint, reflects a strong 8% growth from the 2025 midpoint. Pretty solid.
An 8% step up.
Okay.
And this is where they really accelerated the message, wasn't it? Their long-term EPS growth objective was updated. It used to be something else. Now it's 8% plus.
Right. That plus is doing a lot of work there.
And management then specifically communicated the expectation. They basically said, look, we expect to deliver 9% growth on average through 2030.
Yes. That 9% forecast, it really solidifies the trajectory they see. And mathematically, it's the expected result of that 11% rate-based CAGR we talked about. It all ties together.
Makes sense.
They also maintain their dividend growth objective at 6%. Though they did signal an expectation to trend toward the low end of that range.
Which makes sense, right? If you're spending $60 billion on CapEx.
Exactly. You need to reinvest every possible dollar back into that program. Can't be overly generous with the dividend right now.
Okay, that aggressive 9% goal is great on paper, but let's be real for a second. Q3 showed some serious headwinds.
It did.
Where did those immediate cost pressures actually come from? And I guess how confident should we be that they can overcome that cost inflation and still hit that 9%?
Yeah, Q3 definitely revealed those inflationary pressures. No hiding from that. The largest single headwind was higher financing costs. That dinged earnings by about 15 cents per share, driven obviously by the high interest rate environment we're in.
Okay, 15 cents from financing. What else?
Increased depreciation and amortization. That cut earnings by another 9 cents as, past capital projects came online and started depreciating.
Standard stuff, but still a drag.
Right. And then higher O&M expenses, operations, and maintenance, partly due to health and benefit cost increases, things like that. That cut earnings by another 5 cents.
Okay, so add that up. 15, 9, 5. That's nearly 30 cents of pressure right there in the quarter.
Significant pressure, yeah.
So their confidence then in hitting that 9% long-term trajectory, it must rely entirely on getting constructive regulatory outcomes, meaning state approvals for rate increases, getting capital riders implemented to recover those costs quickly.
Precisely. They are absolutely betting on regulatory support. It's foundational to the whole plan. But what gives them leverage, in those regulatory discussions, it's the load growth they're seeing. That's the key.
The demand side.
Exactly. The primary driver of this huge capital need is, the data center rush. Xcel has updated its total base plan now to include approximately 3 gigawatts of data center capacity.
3 gigawatts just for data centers. Wow.
Yep. And they expect that 3 GW of data center load to drive how much of their overall sales growth?
Let me guess. A lot.
3%. 2 percentage points out of the total 5% assumed annual weather-normalized sales growth through 2030. So a huge chunk.
Okay, so data centers are driving 35th of their expected sales growth. That's massive concentration.
It is. And they even highlighted energizing a brand new data center up in Minnesota just during Q3. So it shows the velocity this demand is happening now.
Okay, if that growth is so concentrated there, is that the major risk, or is the growth actually more diversified?
Well, it's not just data centers, though. That's the biggest piece. They also cited strong C&I sales growth. That's commercial and industrial, specifically in their SPS operation.
SPS, that's the Texas and New Mexico service territory, right? The Southwest?
Correct. Texas and New Mexico.
Yeah.
And they saw sales growth there cited at 8%, which is really strong.
8%. What's driving that down there?
Primarily, it's the ongoing electrification of the oil and gas sector in the Permian Basin. More electricity needed for drilling, processing, transport.
Ah, Okay. So the demand story is strong, but it's coming from these big, specific drivers, AI data centers and Permian electrification.
Exactly. Which means the need for all this new capacity, this $60 billion investment, is both regional and sectoral. It's targeted.
Which I suppose requires some serious supply chain foresight. You can't just, click add to cart for $60 billion worth of grid equipment overnight.
No, definitely not. And management did detail a proactive supply chain strategy. They seem aware of this. They confirmed they've secured long lead time equipment. Specifically noted, they have 19 natural gas combustion turbines already on order.
19 turbines.
And they're proactively managing transformer supplies, which everyone knows are a huge bottleneck right now.
Yeah, transformers are like gold dust.
Pretty much. So this preparedness is absolutely critical because, let's face it, every utility in North America is fighting for the same limited pool of components.
Good point. Okay, let's address the elephant in the room then. Financing. This plan requires a massive capital raise. How do they possibly fund this $60 billion without completely destroying their credit metrics or diluting shareholders into oblivion?
Right, the big question. So the updated plan, looking at 2026 through 2030, requires an additional $23 billion of debt.
$23 billion in debt. Go.
And $7 billion of new equity content, so issuing new stock.
$7 billion in equity.
But they stressed they are committed to maintaining a balanced financing strategy. They want to keep the equity mix around 40% for these incremental investments.
40% equity, 60% debt.
Roughly. Right. For the new money coming in. And this is all designed, they say, to maintain a strong balance sheet and protect those crucial credit metrics. Specifically, they're targeting a long-term FFO to debt level of 17%.
Okay, and for those keeping score at home, maybe just quickly, what is FFO to debt? Why 17%?
Right. FFO is funds from operations. So FFO to debt is a ratio comparing the cash generated by their core operations to their total debt load. It's a really essential metric of cash flow health that the credit rating agencies watch like hawks.
Got it.
So targeting 17% is basically their commitment, their signal that even with this massive new debt raise, their operations will generate enough cash to comfortably service that debt. The goal is keeping their investment grade rating secure.
Which is absolutely critical for keeping those financing costs, that 15-cent headwind from Q3, under control long term.
Exactly. It's all interconnected.
Okay. We've covered the numbers, the huge plan, the execution strategy, the financing. Now we enter the, let's call it the most speculative part of our dive.
The fun part.
Let's look at the logical conclusion, perhaps, of the information we've just discussed. Keeping firmly in mind, everyone, that this is purely a thought experiment. This is not financial advice. Seriously.
Absolutely agreed. Standard disclaimer applies. But given the new $60 billion CapEx plan, given management's accelerated 9% growth expectation through 2030, what's the aggressive yet, plausible trade idea here?
Okay, so the thesis, I think, has to be something like this. Xcel is currently trading with the multiple, the valuation of a standard slow growth utility. Kind of boring, predictable.
Yeah, the market perception might lag the reality.
But its core business, as we've discussed, is transforming. It's becoming this regulated platform builder, catering specifically to these huge secular megatrends, AI, broad electrification.
So the argument is?
The stock is fundamentally mispriced for its newly established 9% growth profile.
Okay, so the pitch, the trade idea itself.
The pitch is to initiate a long position. You'd be arguing that the market just hasn't fully priced in the implications of that 9% expected EPS growth and the 11% rate-based CAGR.
Right. Its price-to-earnings ratio, it's a multiple, should arguably re-rate higher. It should trade closer to faster-growing regulated peers, maybe some of the industrials enabling this build-out, rather than the traditional slow-moving utility group average.
Yeah. And this trade, obviously, it hinges completely on successful execution of that $60 billion plan.
That's execution risk, yeah.
And getting constructive regulatory recovery in those rate cases over, say, the next 12 to 18 months. If they get that,
then the potential outcome is
an expected outperformance against the broader utility sector ETF like the XLU over that kind of time frame as the market digests and validates this accelerated growth story.
Makes sense. Aggressive, plausible, definitely not advice.
Definitely not advice. Okay, so wrapping this up then. The primary takeaway here really is that the market, it seems, decisively looked past the transient Q3 earnings noise.
Yeah, the miss was explained, it was understood.
Because Xcel validated this huge shift toward accelerated capital investment, driven by, well, massive and pretty predictable demand from data centers and broader electrification, they are betting really big, on being the essential infrastructure backbone for the AI economy.
That really was the strategic success of the call, wasn't it? They successfully communicated that, okay, the current financials reflect some cost inflation pain, but their future lies in high regulated growth, fueled by these undeniable trends. However, this shift, it raises a really critical question, something for you, the listener, to consider going forward.
Okay, what's the final thought?
Xcel management. They often highlight, that they offer some of the lowest electricity bills in the country. It's a key talking point for them with regulators and customers.
Great affordability.
So how will the massive capital requirements tied to this $60 billion plan and the corresponding rate increases that must follow to pay for it, how will that be sustainably balanced against those customer affordability concerns, especially if energy prices generally remain high?
That's the tightrope walk.
That balance between the necessary grid investment for the future and the real-world impact on customer bills.
Yeah.
That's the key execution item to watch, I think, beyond 2026. That's where the rubber really meets the road.
That balance is everything. A great point to end on. Thank you for joining us for this deep dive into Xcel Energy.
Always a pleasure.
We'll catch you next time.